Look, most people think building wealth is all about, making more money, driving expensive cars, or just showing everyone on social media exactly how successful you are. But if we actually look at the data for 2026, the smartest approach, it's entirely different. Welcome to this explainer. Today, we're going to cut right through all that noise to show you how true financial independence is really built. It's done systematically, intelligently, and most importantly, quietly in the background.
So let's start off with a pretty crucial question. Ask yourself, are you trying to time the market or are you putting time in the market? Our sources overwhelmingly agree on this one. Building long-term wealth? It's not about perfectly timing those incredibly risky trades or chasing the next viral stock tip you saw online. Not at all. Instead, it's about adopting a highly disciplined educational approach. At the end of the day, it's about what you actually keep and grow, right? Not what you display to the world.
All right, let's dive right into our first section, the quiet wealth mindset, which is all about setting clear goals.
Benjamin Franklin really hit the nail on the head when he said, if you fail to plan, you plan to fail. It's a classic for a reason, because before you even think about investing a single dollar, a true quiet wealth mindset requires you to do a couple of things first. You've got to pay yourself first, and you absolutely must build a solid emergency fund. We're talking 3 to 6 months of essential expenses tucked away. Think of that cash cushion as a shock absorber. It protects your long-term investments from unexpected life events, and it keeps you from making reactive, emotional decisions when things go south.
Now, behavioral finance actually categorizes us into a few distinct profiles, and you've got to ask yourself, which one are you? Are you a risk seeker, always hunting for those high rewards? Maybe you're risk neutral, meaning you need a very calculated return for every single bit of risk you take. Or are you risk averse, putting safety first no matter what? Things like psychological biases, especially the fear of missing out, or just plain overconfidence, they can completely sabotage your plan. Knowing your own profile is absolutely crucial because it helps you stay disciplined when the rest of the crowd starts to panic.
Moving right along to Section 2, the mechanics of compound growth. This is where we start building real momentum. So the whole engine of quiet wealth relies heavily on understanding just how fast your money can multiply. Enter the Rule of 72. This is a fantastic, super handy mental shortcut for investors. Basically, if you divide the number 72 by your expected annual rate of return, you get a remarkably accurate estimate of exactly how many years it'll take for your money to double. So let's say you have a 10% expected return. Divide 72 by 10, and you're looking at doubling your money in about 7.2 years. It's just a really simple, powerful way to visualize the absolute magic of compounding.
And this snowball effect? It actually follows a pretty predictable timeline. You'll often hear it called the 8-4-3 rule. Think of it like this. Those first 8 years, they're simply about building the foundation. Honestly, it might feel incredibly slow, maybe even a bit frustrating, but stick with it because by years 9 through 12, the growth really starts picking up pace as your earlier gains start generating their own new returns. Then, by years 13 to 15, you enter this amazing phase of rapid, almost explosive expansion. Patience and consistency are literally everything here. You have to build the snowball before you can let it roll.
Which brings us to Section 3, the buy and hold advantage. It's all about consistency and patience. When we compare approaches, a buy and hold strategy relies entirely on consistency. On the flip side, active investing relies heavily on market timing, and let's be real, it often comes with some seriously high costs. Our sources point out a really fascinating historical statistic here. Over the past 35 years, the U.S. stock market has posted positive annual returns in nearly 8 out of every 10 years. Just let that sink in. When you zoom out and look at the big picture, the long-term trend strongly favors the patient investor.
But listen, there is a very real, silent danger to trying to time the market. Missing out on the market's absolute best days can quietly wreck your returns. Seriously, it's wild. A massive share of the market's total gains often happens in just a handful of days each year. If you're sitting in cash on those specific high-performance days, your long-term growth takes a massive hit. That's why consistent strategies like dollar-cost averaging are so effective. They smooth out all that day-to-day volatility and ensure you're actually in the game for those critical surges.
All right, on to Section 4, protecting your portfolio. Let's talk defensive strategies.
Because market downturns are just an inevitable fact of life, modern portfolio theory relies heavily on playing strategic defense. And look, in 2026, that traditional mix of 60% stocks and 40% bonds, it might just not cut it anymore. With shifting global dynamics, modern asset allocation involves a much broader, much more resilient mix. We're talking equities and bonds, sure, but paired with international markets, alternative inflation-hedged assets, and of course, having proper cash liquidity.
Now, when a bear market eventually arrives, and it will, you need some incredibly strict rules of engagement. First things first, tune out the noise. Fear sells, sure, but it definitely doesn't build wealth. Second, you've got to avoid those knee-jerk reactions. Never, ever sell just because the market is flashing red. Third, don't try to call the market bottoms. Honestly, they are nearly impossible to predict. And fourth, if it fits your specific strategy, utilize stop-loss orders to limit your potential downside. The golden rule here, your investments should never, ever disrupt your peace of mind.
Let's move to Section 5, defeating silent wealth killers, specifically controlling debt and fees.
So there are these hidden forces out there that act like a slow, quiet leak in your portfolio. Just consider the sheer math behind investment fees for a second. $1 million. That is exactly how much a seemingly tiny 0.4% difference in annual fees can end up costing you. It's staggering. Over 30 years, an investor paying a 0.5% fee actually loses out on over $1 million in compounded returns, compared to someone paying just 0.1%. You absolutely have to know exactly what your money's costing you, down to the decimal.
To combat these silent wealth killers, efficiency is absolutely paramount. You want to maximize the tax-advantaged accounts that are available to you, things like 401ks or IRAs, just to minimize that tax drag as much as possible. Also, automate your recurring investments. Just put it on autopilot to completely remove human emotion from the equation. And as your wealth starts to grow, you might want to consider strategies like direct indexing. Keeping your fees and taxes as low as possible is exactly what supercharges that compound growth over time.
Section 6, doing your own research. This is where critical consideration really comes into play.
You'll see this acronym tossed around a lot. DYOR, do your own research. Basically, it means thoroughly investigating opportunities yourself rather than just blindly following whatever social media influencers are hyping up. This is, without a doubt, your ultimate defensive mechanism. Doing the homework builds your confidence, it helps you manage risk, and it absolutely prevents that dreaded FOMO. And hey, this applies to you too. Quietly increasing your own skills to boost your earning power, that is one of the safest, highest return investments you can possibly make.
Okay, so all of these concepts we've talked about, they build into one unified, highly realistic strategy, the quiet wealth system. Step 1, pay yourself first. Step 2, build that emergency fund. 3, invest consistently. 4, control high-interest debt and keep those fees low. 5, quietly increase your earning power. 6, maximize your tax advantage accounts. And finally, step 7, avoid lifestyle inflation. This one is huge, folks. When your income grows, increase your investing, not just your spending.
It all really comes back to a fundamental truth. The first rule of investing is simply not to lose your money. Now, while all investments definitely carry risk, and remember, this explainer is strictly educational information, we're not giving personalized financial advice here, true wealth is built by carefully protecting your principal. It is absolutely not about chasing fake guarantees or trying to strike it rich overnight. It's about taking a disciplined, highly realistic approach.
So I want to leave you with a final question to really think about. Are your financial decisions working quietly in the background for you, or are you letting the daily noise of the market completely dictate your future? Remember, you don't actually need to look rich to build wealth. Spend intentionally, save consistently, and just let time do the heavy lifting for you. Thanks so much for joining me on this explainer. Keep learning, stay focused on the long term, and I'll see you next time.